Hi everyone, welcome back to Corporate Decoder, the place where we unravel the hidden stories in your favorite company's financial reports. And let me tell you, Enact Holdings Q2 report for 2025 is a wild ride from start to finish. Buckle up. If you appreciate getting straight insights from corporate documents, make sure you subscribe for more deep dives like this. We also have a Discord community linked in the description below if you want to discuss these filings with fellow analysts. So, Enact Holdings is filing their quarterly report, essentially a checkup on how they're doing financially during the second quarter that ended on June 30, 2025. Their commission file number is 001-40399, which is like their unique ID in the financial world. Now, as of late July 2025, they had over 147 million shares of their common stock floating around. That's a lot of ownership stakes. Let's dive straight into their balance sheet. This is like a snapshot of what the company owns and owes at a specific moment. On June 30, 2025, their total assets were a whopping $6.77 billion. That's pretty substantial. And their total liabilities, the money they owe, was around $1.55 billion. So they own a lot more than they owe, which is generally a good sign. Now look at their retained earnings. It's over $3.39 billion. This is the profit they've kept in the company over time. A big number here means they've been profitable and reinvested a lot back into the business. Moving on to their income statement, this tells us how much money they made and spent. In the 3 months ending June 30, 2025, they earned about $245 million in premiums. That's the core of their business, insurance premiums. And get this, their net investment income was over $65 million. That means they're not just earning money from insurance, but also from their investments and earning more from investments this quarter compared to last year. Nice. But they also had losses incurred, which were about $25 million. This is the money they had to pay out for claims, which all adds up to a net income of around $167 million for that quarter. Not too shabby. Now let's look at comprehensive income. This includes other things that affect their equity but aren't directly from their daily operations, like changes in the value of their investments. They saw a gain of about $48 million in unrealized gains on their securities. This is good news. It means their investments are doing better. So their total comprehensive income was a healthy $21.15 million. This next section shows how their equity, the owner's stake, changed. They repurchased about $84 million worth of their own stock. This is usually a signal that the company thinks its stock is undervalued or they want to return value to shareholders. And they paid out $31 million in dividends, so they're balancing returning cash to investors with buying back their own stock. A classic capital allocation strategy. Let's look at cash flows. Where did the money come from and where did it go? They generated a strong $346 million from their core operations. This is the engine of the company. But they used $115 million in investing activities. This is likely them buying more investments for their portfolio, looking to grow that income stream we talked about. And financing activities used up $217 million. This is where those share repurchases and dividends come into play, as well as maybe paying off debt. Overall, their cash increased by about $13 million. Not huge, but they are generating cash. All right, let's talk about what Enact Holdings actually does. They're basically in the business of mortgage insurance. They protect lenders if a homeowner can't pay their mortgage, especially for those buying homes with a small down payment. Here's a key metric. Their persistency rate was 82% in the second quarter of 2025. This means 82% of their customers kept their insurance with Enact. That's a strong retention rate showing customers trust them. Now their loss ratio, that's how much they paid out in claims compared to what they earned in premiums, was 10%. That's pretty good, especially when you compare it to last year where it was actually a negative 7%, meaning they got more back from reserves than they paid out. The economic backdrop is important. The unemployment rate in June of 2025 was 4.1%. A low unemployment rate is generally good for mortgage insurance because it means fewer people are likely to default on their loans. There are some regulatory shifts happening too. The FHFA, which is a big player in the mortgage market, is changing how they accept credit scores starting in July 2025. This could impact how Enact assesses risk. Good news on the ratings front, Fitch upgraded their insurance arms rating to an A. This means they're seen as financially strong and stable, which is attractive to customers and investors. They wrote new insurance for $13.2 billion in the second quarter of 2025. That's a pretty decent amount of new business. And their total insurance in force, meaning the total value of all the policies they're covering, is nearly $270 billion. This shows consistent business growth over time. They had about 22,000 delinquent loans. This is a number to watch. While it's a small percentage of their total business, an increase here could signal trouble ahead. Their reserves as a percentage of risk in force, meaning how much they've set aside for potential losses compared to the total risk they're covering, is 32%. This seems reasonable given the nature of their business. The company puts a lot of emphasis on its investment portfolio, emphasizing highly rated fixed maturity securities. This is their safety net, ensuring they can pay claims. The duration of their investments is 4.5 years. This is a measure of how sensitive their portfolio is to interest rate changes. A duration of 4.5 years means the value of their investments would drop about 4.5% if interest rates rose by a 4%. Looking at the cash flows again, they generated substantial cash from operations, which is the lifeblood of the company. Financing activities show a significant outflow, mainly due to those share repurchases and those dividends paid to shareholders and their parent company Genworth. Now, here's a bit of a constraint. Their insurance subsidiary Emeco has to maintain certain capital levels. This might limit how much money they can send up to the parent company as dividends to shareholders. Their risk to capital ratio for Emeco is 10.3. This is a key measure of their financial strength relative to the risks they take on. A lower ratio is generally better, and 10.3 is a solid number, well within regulatory limits. And to wrap up the financials, their financial strength ratings are quite good, with Fitch upgrading them to an A. This really shows confidence in their stability. So looking at Enact Holdings, they're operating in a solid market, but one that's very sensitive to economic shifts. Their core insurance business is performing well, with good premium growth and reasonable loss ratios. Their investment income is also a growing positive. The share buybacks and dividends show they're committed to returning value to shareholders, but those regulatory capital requirements and limitations on dividends from their subsidiaries are something to keep an eye on. The company seems to be managing its risks effectively, as shown by their strong financial ratings and healthy risk to capital ratios. They're doing a decent job of balancing growth with financial prudence. Alright, that's our breakdown of Enact Holdings' latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us continue making these deep dives, and subscribe for more. And don't forget to join our Discord community, linked in the description, to keep the conversation going. Thanks for watching. See you next time.